going. All right, and we're live for our final education session of the Summit Prep program for Summit 8. Last night was the kickoff for the investors. They're going to be starting to review the companies. We're heading into the summit, which means you got to be thinking about how are you going to be raising your round of investment, because there's so much more capital needed than just the capital that startup TNT can help you raise. And so you got to think about a round of investment. What even is a round of investment, you might be asking? Well, we're going to learn all about that today. And I'm so happy to have three amazing guests with me here today to help you learn a little bit more about what it takes to raise a round and how to go about managing expectations with various stakeholders in your business. So to start it up, I'm very happy to have Jacques Lapointe here from Metiquity Ventures. He's a co-founder and director there. Jacques, why don't you want to just say hello and say a few words about who you are and what it is that you do at Metiquity?
Sure. So Jacques Lapointe, I'm co-founder and director of Metiquity Ventures. We're a early stage investor. We are a venture fund, and we invest in early revenue, pre-revenue companies.
Awesome. Yeah. And very excited to have one of the companies that's actually in your portfolio here today, represented by CEO Liz O'Connell at Arolytics. Liz, why don't you say hi? Tell the audience a little bit about yourself.
Hey everyone, thanks for the introduction, Jesse. So I'm one of the three co-founders and the CEO of Arolytics. We're a clean tech software startup. Our platform enables the oil and gas sector to forecast and manage their greenhouse gas emissions data, primarily methane. And we are a seed stage company. And also Metiquity is one of our our lead investor from our first round. So I'll kind of touch on that. So there's an interesting connection between us too. So thank you.
Yeah, excited for that conversation because that's an important part. Lead investor, we're going to dig into that. Before I do, I got to talk about the finance lead here at Startup TNT and a TNT angel investor, Richard Tuck out of Winnipeg. Richard, why don't you say hi? Tell them a little bit about yourself.
Yeah. Hello, everyone. I started down kind of this journey in angel investing through I had a small exit through a tech company about 8 years ago, and started helping other kind of companies and then looking to see how to invest and so I basically started investing in companies and mostly in the States and then Vancouver and Toronto. And then my family said, "Come back to the Prairies, please, and you're a terrible uncle." And so I moved to Winnipeg, and been in the ecosystem here. When I heard about Startup TNT, I was like, "Yes, I want to be an investor." Just because the impact was crazy. I'd never seen anything like it. And at the time I was actually working for government, and to be very honest, no one at government had ever seen anything like it. And so it was, so I joined, and then they were looking for someone to lead finance, but also, we're building a fund for follow-on investment. And the goal is by 2030 to have it to about 100 million. And part of that is going to be coming from the social finance fund, and that's, I have Walkabout Financials, is my social finance company, and there's this again, there's over 2 billion coming down the pipeline from government and a couple others, and so it's like, how does this play within early stage is really intriguing for me.
Thanks, Richard. Yeah, we're so happy to have you back here in the Prairies working with us at Startup TNT. So yeah, talk about raising capital. That's what we're here to talk about. So let's learn a little bit about the history of our panelists with how they've raised capital. So start with you, Jacques. You were founder of a company out of Calgary. Why don't you talk a little bit about your journey with raising capital?
Yeah, so I have a benefit of being on the investing side originally as well. So I first have a background in commercializing technologies in a variety of companies, then went on the investing side with a company that did early stage as well. And so having that experience, I joined as a founder of a robotics company and raised over $20 million in 3 years. under 3 years. And, that was from angel investors, strategic investor, family office, and a US venture firm, not to mention a fair chunk of non-dilutive. So that's been kind of my journey of raising money. And currently we're raising our fund. We're 60% of the way there, but we're, raising to invest in companies.
Yeah, just double click with each person here as we go through. What were how long did it take you to raise like your first couple rounds of financing, from like the time you decided you were going to start raising to the time you actually got all the checks in the bank?
Yeah, so you're going to hear this over and over from me, and Liz has heard this too many times probably, but you want to be in a position of strength. So I was raising all the time, but not officially saying we're raising. So often I'd be saying, hey, we'd love to meet you, tell you our story. And, we're not really raising money right now, which is really a trigger to make the conversation easier, but then get them excited about the business so that they are in a position to raise. So we were effectively raising every 6 months, and, always pushing the point of strength. It's like, okay, we just got a grant, we've got money here, so let's go tell the investor so that they can invest some money in it. It'll be like a 1-for-1. They'll get $1 for their dollar they put in, that kind of thing.
Awesome. Thanks, Jacques. Liz, let's go to you. Tell us a little bit about that pre-seed round. You're also a TNT Summit winner, which is pretty exciting.
Yeah, so we've raised capital twice now as our company, and the first was our pre-seed round. And with that round, that was my first time ever fundraising. I was going in a little bit blind, just reaching out, cold emails, that kind of thing, learning on the fly. And what really expedited things for us is winning the TNT Summit back in, I think that was 2021. And from there, it was amazing what traction we were able to leverage from that quite quickly after we secured our lead investor with Metiquity. And then we ended up doing side deals through investors that we met with the TNT Summit. And I think we raised in total about 500,000 through just TNT connections and through the summit directly. And the total raise with that one was about just over 700,000. And so learned a lot with that one. The process was not quick. I'd say that was, a little bit slower, a little bit learnings with that. But it's amazing just when you land that first one, what you can leverage for traction to actually kind of close. And the rest came together really quickly after that. And then fast forward to today, we just closed our seed financing. We announced the press release about 10 days ago, and BDC Sustainability Venture Fund is our lead on that one. And with that, I completely ran the process differently. The best piece of advice I got was run it like a sales process. So I built a CRM of investors. You have the different pipeline stages, and I really was focusing on efficiency and trying to get to no's as quickly as possible. Of course, there's going to be no's in the investment process, but the worst is when it drags on for like 5 months, so, no means no, that's okay, move on, put them to that, other stage in the pipeline. And I was able to just do things much quicker and, really shorten the time that you're fundraising with that seed round. So there's a lot of learnings from that first to second round. And with that round was 2 million in equity that we just closed, and 3.5 with non-dilutive.
Yeah, round of applause for that. That's great. Thank you for that answer too. You actually preempted the question I was going to ask, which is like, what's like the big lesson that you learned kind of between the two rounds? Getting to that no quickly. That's what one of the people have mentioned that he liked about the startup TNT process is you get eliminated, then you have to know, as opposed to sort of the Canadian no that you often get here, where they're like, oh, just come back to me like in a little bit with some more information and maybe I'll invest. So something that's a great piece of advice for our founders here. Richard, coming to you, what was your history with raising capital? I know you built some companies down into the US, so tell us a little bit more about that.
Yeah, there's so much in both what Jacques and Liz have said that like we just branch off and have other conversations right now. But yes, kind of agreeing with with what they're saying. So I wasn't necessarily the founder. It was a student group and that I was teaching. I loved their project. A year after they graduated, they came back to me and they said, we haven't gotten anywhere. We actually need a CEO. We don't have any experience in this. And I started other companies. I've never started a tech company though. So I joined them and we did a $1.8 million seed round. In total, it was 1.8. I say 1.4 sometimes because I feel like the work that I did was just 1.4, and then the investors at some point, the U.S. investors, I think he needed to get rid of some capital and just like deploy it, and so there was a bigger check that arrived to the bank the one day that was a very big surprise to me. On that date, however, it was so Google did a conference called Home is North in Toronto, and it was a big conference, and it's so bad that it's too bad that they don't do it again. But it was a really awesome. But that was the day that I found out. Like I got a message from the bank saying this has been deposited, and I was like, what? And so I texted on the Slack, and that was it. But at that conference, it was they had talked about it was a great panel, probably the best panel of speakers I've ever seen. But they had investors, and they were saying, quick no's, Canada, you have to get to quick no's, right? If you're taking longer than 6 weeks to say a no, then that's you're doing a disservice to the entire community. And I am so thankful that we're talking about quick no's. Quick no's are your best friend because then you're not wasting time. And I think at the very beginning, of raising, I would say that we didn't have that sales process in place. And now I teach that sales process. And so it's really great. And then I've helped, I've given that process to other founders and people I mentor, but also the startups that I've worked with in order to get them kind of investment ready and then go. I think the other part of your question, Jesse, was kind of how long, and it's how long is really a weird question because as Jacques said, you're kind of always raising and always not raising, and so it's like there's a point where we knew we had to hit a certain milestone before we could actually raise. But we were doing that diligence, and we were doing that work and that pre-work and kind of having those conversations that Jacques was saying about we're going to open our round, or we're thinking about our next round, or we're thinking having those early stage conversations. So in total, if I include that, it was probably 14 months. And then the shorter end would probably be about 8 months, where we actually we had everything, we had the legal done, we had structure, all of those things, and it probably took us about 8 months to raise.
Jesse, let me just comment on quick no's real quickly.
Please, yes.
I mean, as a company, I like quick no's because you know where you stand. As an investor, sometimes though, like we will watch companies over time, right? And so it's often not now, so that's sort of a no. But at the same time, if you're talking about a true sales process like these Liz and Richard talked about, you'll keep those people in your pipeline, but you'll just have to nurse them that aren't a full no, right? And so it's frustrating as a founder when you don't get clear direction from some of these investors. But from my point of view, sometimes as an investor, I want to see a company over time. I want to see how their reaction is. I want to see their perspective on, valuation, et cetera, over time.
100%. I always say ask not necessarily why is it a no, but frame it into, hey, for my next investment meeting with another investor, how can I improve? That might be a better way to get a more kind of solidified answer. Investors, just like, so startups talk, right? So investors have reputations that they have to protect, just like startups have reputations that they have to protect. Investors talk, startups talk, and they talk about each other. And so you want to, as an investor, or as a startup, you want to keep them in that pipeline. You want to nurture that relationship. These are all based on relationships, right? So you want to nurture that kind of stuff. But yeah, keep them in your pipeline. Ask kind of questions. See if you can add them to, if you do quarterly or bi-yearly kind of updates, potentially push those updates to them. And again, you're nurturing that relationship.
Yeah. And actually, I was just going to follow up on that, Jacques. I'll ask here, what questions or how should a founder be approaching a situation where a VC firm has said not now, right? And
Yeah.
in order to like effectively keep that relationship moving towards a potential yes.
Yeah, and I mean, I think it's really important to, as a founder, you know, I could say I'm an expert at raising money, but I still don't think I'm an expert. There's always something for me to learn. So as a founder, I think you want to be asking genuine questions that you're seeking long answers to. You know, it's like, okay, so it's not now. Give us some indication on what you like, where you invest, how, you know, how we can change. You know, what do you need to see from us? Is it traction? Is it, you know, X dollars in the bank already? Whatever, you know, like you got to just get them to start talking so that you can understand their thesis more, and specifically how it relates to your company, and you know, create a partnership dialogue. Like, hey, I'm not an expert. I'm trying to learn from you. And I've done that hundreds of times, and you know, great conversations come out of that.
Liz,
Yeah,
anything
can I
to add here?
share?
Yeah, perfect. Yeah,
Just
you wanted to jump in.
really quickly, some advice from a no that's I've always remembered. So it was actually in our seed financing round. There's a great investor. It was a no. So I did that kind of, 20-minute just feedback call, which I love it. They're so useful. And their advice was be more concise. And she's like, you know what, Liz, we see hundreds of pitches.
Yep.
The pitch we did with them was an hour. It was at like 4 p.m. on a Thursday. And I think people were just glazing over a little bit because I was just talking so much because I'm very passionate. And she's like, we love everything. Like, just the delivery was not as concise as it could have been. You have to hit those key criteria points that all investors are listening to. And so the challenge to me was how quickly and concisely can you deliver that message? And so from that has completely changed how I pitch in the future. Less is more, just cut to the chase. These people, time is of the essence, and, less rambling. So that was really important feedback I got.
And just to double click on that, Liz, how did you go about, like, what was sort of the process for you to get more concise? How did you workshop it? Did you have to have meetings with people? How did you go about doing it?
Awareness was the main thing. As I'm talking, I have that feedback in the back of my mind, and I'm able to just, literally say it in a sentence instead of 20. So just always have it in the back of your mind, really just practice.
Yeah, have that clock. Yeah. Jacques, Richard, let's just demystify a little bit of investor speak here. Lead investor, right? This gets thrown out a lot, right? Like, what are investors actually talking about when they say lead investor, right? And why do so many investors say, I'll invest once I get a lead investor, right? So we'll start with you, Jacques, and then go to Richard.
Yeah, so Liz knows that I have a slightly different perspective on lead investor. And when you get into later rounds, and I saw a question in here, we invest in pre-revenue, early revenue. So early revenue means, like a couple $100,000 maybe. So that was just to clarify a question in the chat there. But in terms of, I'm trying to remember the question again. Oh, the lead fee, sorry. I'm thinking too much. In terms of a lead, like I think of a company as raising a round. And so you kind of want to create the perspective of who is going to step up to be a lead. Like if you're raising a $750,000 round and you've got somebody ready to commit 50,000, 200,000, you want to close on that. And it's closing on your terms. If a big lead investor comes in and says, I want to take the majority of the round, here's my terms, they're slightly different than the ones you achieved with the other investor. Guess what? The big dog is likely to influence the little dog, and they're probably wanting better terms than the little dog got anyway, right? So I think about it as we're raising money to do something, whether it's product development, expand our team, move into the US, blah, 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 right? But don't let yourself define the round as much as letting the investors define the round. And so if somebody says, well, I'll jump in once you have a lead, okay, great. That's their definition. They want a lead, fine. So then you continue on your journey. But along the way, unless you're raising a $10 million round where you're typically in VC territory, there's more of a structured situation where they have lead investors. So they're looking for a lead to do the due diligence, et cetera, and then somebody will syndicate with them. And there are some investors on the VC side that are only syndicate investors. They will not lead. So But when you're in more of these angel or smaller rounds, it's really about, hey, I've got a $500,000 round, $750,000 round, $1 million round. I'm trying to fill that. And so you don't want to lose the opportunity to take a $100,000 check unless, there's a misfit between the investor and yourselves.
Richard, anything to add there?
Yeah, I think so. I think things like safes, or I think that there's new things that help what Jacques was saying. So for me, lead investor is most likely going to take the over 50%, but it can be over, let's say, 35 to 40% even still. But a lead investor for me is the one that is putting a bulk of capital in and doing the due diligence. And the reason why you'll hear things like, once you have a lead, I'll invest, is that they don't necessarily have the ability to do full due diligence that's necessary to make an investment, right? Because due diligence is time. It's, as we'll get through the process here in TNT, right? The true due diligence takes a bunch. It takes legal fees. It takes all sorts of capital and time and resources. And so if I'm an investor and and especially if I don't necessarily, I like you, I like the idea, but maybe I don't have the aptitude to really gauge the tech or gauge, some component of what you're doing, then I love it. Again, I'm passionate, I see what you're putting down. I just don't have the ability to assess the risk properly. And so I need a lead investor that can actually do that.
Liz, when you were going out and trying to find a lead, how did you go about doing that? Right, you have a lead investor on both rounds of investment that you've done so far. How did you go about finding that person, and kind of talk us a little bit more about that?
So when we were launching our financing, again, back to the sales process, we created a leads list of investors, and we prioritized them tier 1, tier 2, tier 3. And everyone has their dream idea of what their perfect investor looks like. Whether or not you'll get that investor is another story, but classifying them in different buckets was helpful for us, because our strategy was to, we actually started talking to some of the tier 2 investors first, let them kind of, de-risk the pitch, they'll give feedback. Our data room got much stronger because they had questions. And then, about a month or so later, okay, we're ready to hit the big wigs and, try and reach out to some of our bigger targets. And so that kind of de-risked it for us. And then from there, you always have that fallback kind of tier 3, which is still, at the end of the day, money's money and beggars can't be choosers. So having an idea of really who is your ideal was really helpful for us. And it kind of sets that objective very clearly. And finding the lead is just so amazing, because it really creates the whole expedites the whole process. One thing we really struggled with when you don't have a lead, you're getting asked the same questions by 5 different parties you're talking to, but they all want it in a little bit of a different format. And that just sucked up so much time for us. But as soon as you have that lead, let them kind of work with you, and it's, you're now partners, and let them kind of also get traction with other investors. A great example of that is, sorry, Jesse, if I'm jumping to one of your questions, but the customer calls. So with customer calls, instead of having 5 different investors all call different customers, that gets messy. Let that lead investor lead that process, do their own DD, and have them connect with the other investors to get their buy-in. Just a lot of streamlining can happen once you get that lead. And with Metiquity, that was a really smooth process for us. And same with BDC, actually, they just kind of took a lot of that ownership on, which was wonderful.
That's great. Yeah. Jacques, as these founders, I know you were a founder yourself, going out and looking for the lead, what should they be looking for? What is how do you find that in terms of looking through all the different databases of VC firms? What should they be looking for to find a lead investor? And also in the meetings, what are sort of the phrases and speak they should be listening for to know that these these firms are actually serious about potentially investing and leading the round?
Yeah, it's kind of interesting because, like Liz talked about the sales process, right? Because you want to identify however you can, through other companies who've raised money, they'll have no's that they've received from other investors. Every investor you talk to that is a partial, thinking about it, whatever, you can still talk about, well, who do you co-invest with? And, do you know of others? So it's a real journey to try and build that database, if you will, of customers. But I think a really strong statement to a lot of investors is, hey, we'd love to tell you our story. We're thinking about raising money. And then when you get to them, you can say, hey, you know what, we've been talking about it. And you can either define right then and there and throw your ask out as, hey, we are doing a round since we, reached out to you 3 weeks ago because it took 3 to 4 weeks to get this meeting. We are doing a round and here's our ask, and, would you be interested, right? So I think you just try to be as conversational as possible, and it's a meeting for both of you, and when you're not officially raising, that can help take the tension out of it, and you just start with conversations about how do you guys invest, where do you invest, even though you've read it and looked at their website and that. And so I think it's really understanding what they look for and why, and what's their mandate of their fund, and the people involved and who they'd be talking to, things like that. So there's no silver bullet. Every situation is different. You walk into a room and you've got a bunch of people in there. Some are, analysts, some are senior partners. Maybe it's not even that. And so you got to read the room and go with the ebb and flow.
Love that. Great advice. Richard, coming to you, thinking about like the negotiation phase with the lead, right? How did you sort of approach that with raising a round, and even now on the other side as an investor and also advisor to companies? How do you talk about that with the founders, or how did you negotiate?
It's we raised probably close to a decade ago, right? So this is that one was a little bit. I'm trying to think of like the errors and whatnot. So we couldn't find a lead in Canada. We were very specific. We were ed tech. Back then was either people went right away and said no, or they said yes, or maybe, right? But there was a lot of like immediate no's. We are also a double-sided marketplace, and that was also a no, right? So those were lots of really, really early no's. Once we got into the US, we went to an actual accelerator in the US. Canada doesn't necessarily have accelerators per se, but we went to an actual accelerator in the US, and their network, and we talked to them and looked at, what is everybody else doing? What's the market doing? Yeah, they're gonna give some push, but at the same time, it's a relationship. They want it to be, it's longer than this one investment, this one moment in time, and so there's, unless you're wildly out of whack, they're not gonna necessarily push back. That, again, that I remember. Now as an investor looking, and especially in Winnipeg, I see, like it was the first Startup TNT summit that I went to, and I just sat there and I was like, wow, like y'all are asking for, like, your valuations are super high. And yet you're not asking for enough money to give you the runway to do what you really need to do. So I'm just like thinking and going, and I was like, those are two really, really drastically different things. I don't know if Jesse has the stats, but there are stats, within TNT of, in the top 5 who make it, or even going from the top 10 to the top 5, what the valuations are. And then from the top 5 valuations, who actually gets investment. And there's a strong correlation between having a more, justified amount, a little bit lower than the rest, in order to actually get this early stage capital, because it is really high risk. And again, I think that there's a little bit of delusion in the startup world in the last couple of years of where we really are.
Yeah, Liz, coming to you, thinking about that, the valuation conversation, that's so important for founders. Obviously, you want to build a great company with, you need the capital to do it, but you don't want to lose too much dilution, don't want to lose control of your business. So how did you approach that in the negotiation phase for the 2 rounds that you've
Yeah,
addressed?
absolutely. So it's a conversation, and I would recommend burning it up. Don't wait till that final minute when you get that term sheet to be surprised about what this valuation is, because there could be massive misalignment. So it's better to just broach it maybe second, third meeting. This is my expectation within a range, and what is yours within a range. And so I would really try and have that pretty upfront, because that could be major misalignment issue. And to me, it's always a discussion, and I think it's important to really back with data. So I'll give an example of our more recent round. We did actually successfully negotiate our valuation up at the last minute as we were doing term sheet negotiations. And the reason being is that we had really strong data around comparables and other research that had been done in this area. And we even actually worked with an investor that had said no. He built us a probability valuation model and became a mentor in a sense, and actually worked with us on creating this kind of top-down valuation model that was quite defensible. And so with those different tools, we were able to have data that said, hey, look, what do you consider this? These are the reasons why. So never just ask it without a strong basis around why, but doesn't hurt to fight for what you want and what you think is best for your company. That said, I would be cautious. This is something I learned as well. Skyrocket valuation can really bite you in the butt down the road. Like, it has to be realistic, because that's putting a peg in your company. And come that next round, you have to show very strong, growth from that valuation. So if you go way too high, how are you actually going to hit that next milestone with that valuation growth that you need to hit? So it's important to just be mindful of that and choose something realistic and fair for both parties.
These are such great nuggets, Liz. Yeah, the comparables one is just to give a quick example. On the other side, we had a company that came through where we invested a safe, which we're going to get to here in just a second, talk about that. We invested on a safe, and then a lead investor came along, and it was less than half the valuation after they did the comparables exercise. And the lead investor did all the comparables. The company did none of it. And so they didn't really have control of their own narrative. And I think that was a key reason why they kind of lost in the negotiation in the end, so to speak, by having that valuation come down so significantly. So that piece of advice on the comparables, super valuable. Jacques, coming to you on the safe conversation, and we'll kind of go around the panel then and hear from everybody on this. How should founders be thinking potentially about using a safe round? Safe is an option. They can do it quick and easy. You don't have to necessarily get full legal involved. You can set a valuation number as a cap. It's not necessarily the actual valuation of the company today. So how should founders be thinking about potentially using safes to pull a round together without a lead potentially?
Yeah. We're not actually huge fans of safes. They are a good vehicle to do something quickly, especially small amounts. But as you get a stack of safes going, it becomes less attractive for investors to look at it, because the cap table starts to look a little funny, and you're wondering about, is this really an investment structure? So, we tend to, when we come in rounds, we tend to try to get everybody back to common shares. It's often too early in our phase to think of preferreds, although we have one situation like that. So, you really have to balance, and you have to push your legal team to say, look, I'm doing a small investment here. I don't need a whole lot of legal. So, is a safe the right thing for me to do right now or not, right? So that's kind of our perspective. In other regions, and part of the reason that I say that is there's a number of investors in the space, in our ecosystems, particularly the local ecosystem, that don't like safes, right? They want to invest alongside the co-founders and the founders in common shares, right? And so you have to be a good balance of what makes sense. Yeah, I could ramble on, but I won't.
Richard, we use safes a lot here at TNT. Where are you at on this topic?
So I kind of wish safes existed, back when I was raising. I do agree that, if you start stacking safes, your cap table looks crazy. Like, I would not suggest doing that. The reason why, if we look at the kind of the reasons, right? So convertible notes, the downfall of convertible notes is that they sit as debt on your balance sheet. So if you then require, and think of your investment, your total amount of money that you need, right? And so some of it's going to come from equity, some of it's going to come from potential debt. Everybody talked about leveraging that against, kind of government grants and free money, right? So there's all of this that ends up being your total package. If you have a big amount of debt sitting on your balance sheet, you have no ability to go and leverage anything from the bank. And so that's really the big problem that again, Y Combinator saw in doing convertibles is why are we disadvantaging the company, right? And that's again, because at the end of the day, they're sitting there going, we're looking for successes. So any type of disadvantage that you do, that's where it lies. The thing that I like about safes is that, and we did a common share. Common is really uncommon. Preferreds are more common because it guards against certain things, so it lowers the risk for investors, right? So that's why preferred. But again, the reason why I like safes is comparatively is because of the whole valuation thing, right? When you're really early stage, and again, this is where safes belong, really, really early stage. When you're early stage, you don't know what the hell you're doing, right? You don't know how much of the valuation really is, and trying to do all that work, knowing that you're not going to do it right? So number one, you're not going to do it right. So knowing that you have to do a bunch of work and knowing that you're not going to do it right. And then to Liz's point, if you end up potentially going too high, then you shoot yourself in the foot later on, right? This kind of sits there and says, you know what, I'm too early stage to think about this. So let's just do a safe. We'll put a cap. We'll make it very standard. It's not going to affect my balance sheet. Let's just do that. So that's why I really like safes, is because it basically guards against two things. But again, 100% with Jacques. Later on, as soon as you have the ability to start figuring out what your actual valuation is, figure it out, do it, close it. The people in the prairies, especially, really like, again, common or preferred. And so having a valuation, because then they get access to the tax credits, right? The safe right now for at least for Manitoba and I know other provinces, safes aren't considered. They're still considered convertible, even though it's not a debt instrument. So that's why I actually really like safes.
Yeah, just
to
add there, if you don't mind, Jesse, just from the founder perspective, we tried originally in 2021 to raise with a safe, and that got shut down by a lot of different investors we were speaking with. From my experience, it's been a lot more common with US investors we've discussed. They seem to be a lot more comfortable with that. And in Canada, it's just a little bit less common. So for us, it came down to a fact of, okay, we have a choice. If we really want to stick with the safe, we need to change the investors we're speaking with. And it came down to, at the end of the day, we love the people we were talking with. So we were willing to just switch over to common shares. And that was fine for us. So I think having a little bit of flexibility in the instrument you raise with is important, because at the end of the day, unfortunately, the investors have a little bit more say and power in that regard. If you want to work with them, a lot of them just say yes or no.
Yeah, I'll just add one. Go ahead, Jacques.
Maybe just one comment on convertible debt. One comment on convertible debt, like, it is bad because it shows up on your balance sheet. But if you have optional conversions, then it's harder for the company. If you have, sort of forced conversions at specific rounds that you're planning ahead, then it can be okay. But it is I don't like them either unless they're designed for a very short period of time.
Just to answer that question in the chat, Doug, yes, SAFE can be set up to convert into commons. A lot of investors, including Startup TNT, actually try to set it up so it converts into preferred shares only. That's another reason why, that's one of the reasons why we like to use it here at Startup TNT, is because we would like to get in on a preferred share deal, generally speaking, and we don't have the horsepower and the capital, as Richard mentioned, to do all that legal work, put it all together. And so that's how we're approaching it. And to the point on, sort of the education on the investor side, that is one of the reasons why TNT, does these education sessions. We are trying to get better information to both founders and investors on the various instruments that are out there, the benefits of them, and then everybody can kind of make their own decisions. I know we've actually had situations in the past where we've sort of anchored the terms. I wouldn't say leading, because it was like 25K on a 200K round, but the other 175K followed on with us because we had that sort of level of sophistication, and that often can be what you need, especially in those really, really early rounds where it's essentially friends and family, or pre-seed, as we like to call it, for those early rounds. Is just having someone around the table who knows what they're doing, right? And so that's where Startup TNT is trying to fill into the ecosystem. Pivoting slightly, because this is a topic that has come up from a number of founders that have talked to me during summits and post summits, is employees, right? So how do you manage the morale of your employees during a raise? Jacques, you built a company kind of from zero all the way up. How did you go about doing that, especially as you started to get into those bigger rounds where it's make or break with the company?
Yeah, I think continuous dialogue is super important, but you have to understand what the extent of the dialogue is, right? Like if your employees, you may have one or two employees that are super concerned because they got a mortgage and they never worked in a startup. Maybe, you've got 6 months of runway and they're starting to get sweaty and worried. So on the other hand, if you've got a good cadence and you're paying your teams reasonably well, then it's just dropping little hints about what's happening with the raise. Hey, we're raising money, we're going up. You don't have to tell them everything, right? You get into a bit of trouble, I think, and we saw this with a few individuals. Because they were early employees, they felt like they were founders almost, right? But yet they were getting, a B minus, B plus salary plus some options. And so, managing their expectations and managing their expectations of what happens post round, do they get a raise after that? Or, by the way, all this money is being raised for, product development, expanding sales, more people, moving locations, whatever, right? So you got to focus in on what the money is going to be used for and manage the expectations around what their stake in that new money is, because sometimes they have expectations that, oh, we raised $1 million or $5 million and now I should be getting paid, XYZ, right? So there's some of that. And then also, early companies, people develop their own expectations as they join the company, even though they're not the founders or what have you. So you just good dialogue, staying up to date with people, give them regular updates, casual, do it over a lunch and learn discussion or what have you, right?
Great advice. Liz, how did you manage that across these 2 rounds with your employees?
I don't think employees really need to, they don't need to know how much runway that this, all the details of your company. That's not their, their job to really be concerned about that. But I think what they should know is that, you're going through a fundraise process. This is generally how it works. A lot of people that join startups don't actually know what an equity raise is. So just a little bit of education around it. One thing that was fun we did is I gave our investment pitch to our whole company and asked them for feedback. And it was just a really fun way to get the team involved. And throughout the raise, I would give little updates. Hey, we are, we got a term sheet from this company and we're, just keep it really high level, but exciting, oh, we hit this milestone and, oh, we just closed and this is our new board member. These are all the credentials. She's amazing. And just get buy-in and excitement. And then we did go out for a little team lunch when we closed, because it is something that the whole, company should kind of, celebrate, and it is exciting for them. But I'm with Jacques, like, some detail, but you really don't need to give them all the details of, oh, this investor said no today, this one said yes. So just high level details.
And when you have a small space, like we were in a commercial bay, it's like when anybody walks in, people know there's something going on. So you always get questions, right? Like, it's like, who's that? Who are those group of people? And, you got to dialogue something anyway. So.
Yeah, just thinking about that too. I know like a lot of early stage founders, and we're going to come to you in a second, Richard, but they can, they maybe only have like a team of 4 or 5 people, right? And they sort of drop everything and sort of lament everything onto those people every time. So how do you sort of like manage that when you're like, you have all this stress on you? Liz, I'm going to come to you on this one. Like, when you have all this stress on you as a founder, because you're like, if I don't raise this money, this company's going to go under, and all these people lose their jobs, right? It obviously feels a little different. So how do you sort of like think about that with your interactions with your employees?
Yeah, that's a good question. Don't let that stress trickle down to your employees. That's important. And hopefully you're starting your fundraise process. And I mean, I don't have all the answers, or I'm still learning all this too. But one learning for me is just start a little bit earlier than you always think you need, right? You have, what runway you have, but it's always going to take you a little bit longer than you think. So hopefully you can avoid some of that chaotic, oh, we're going to run out of money in 4 months. Like, that is absolute worst case scenario. So you should really see that well in advance. But I think I've heard someone say like CEO is chief enthusiasm officer. I think it's important to just keep that culture of positivity and hey, we're just working towards the next milestone. But not let, if you're stressed, that will absolutely trickle down through the team, and they'll feel it. So important to be aware of that.
Richard, any comments on this topic here?
No, I absolutely love what Liz has said in both statements, and so I think the only thing that I would add is that it is going to be frustrating. So make sure you have a support network outside, and that might not be your family either, right? Because they don't necessarily understand. I have to say that Keith Ippel from Spring, out in Vancouver, was a godsend 10 years ago for me, because he was a mentor, and I was frustrated at times, and he really got me through in order to be like, hey, that's what you got to do. Like, it's okay to be frustrated. You're going to be frustrated, but how do you move on? And so he was amazing.
Yeah, the one thing I would add is that, like Liz did, got their team participating a little bit. There's certain nuggets that sometimes you can get your team to do that are important for the raise, right? And so I remember one thing that I wanted to do was like build sort of a simple model that helped to estimate and scope how we would sell our product to customers. And so we got the developers excited, because I wanted to show investors that we were sophisticated enough to be already in selling mode, even though we weren't ready to sell. And so, selling the investor and selling the employee on, hey, if you develop this will be really great for us to present. And, it was just an interface into a spreadsheet effectively. But, like that was important to show the investors that we had a system already,
I like that. Yeah. Getting your employees to help build those tools that you need to win over investors. One of the other groups, Liz, you brought this up, customers is an important group that will often need to at least have some sort of interaction with potential investors as part of the due diligence process. How have you managed that? In particular, we've had some concerns from founders where they're like, oh, I don't want you to talk to these people because, they might end up scaring them off or something like that. How do you sort of manage that conversation and making sure that you don't hurt your relationship with customers while you're raising around?
Yeah, for sure. I think, to be honest, customer calls, there's something that has to happen, but I think, they do need to put you do need to put intent into managing that, because at least for our company, our customers are so busy, it's a struggle for us to get their time, let alone a bunch of investors calling them. So really explaining to the customer this is the intent, but also I think it's really important to spin it positively as to how it will benefit that customer. Hey, so we're raising a big seed round where it's going to expedite our growth. We're going to scale our team to be able to, offer companies like you guys a lot more functionality with our platform. And to do this, can you give them a little bit of your feedback on working with us so far? So just put it in the bigger picture of why the conversation is important, and it will ultimately trickle down to benefit them, or it should. So I think that's important. But again, just coming down to trying, if you have that lead investor, that person should ideally be the one to do the customer calls, so they're not getting bombarded by a bunch of different investment companies. So hopefully it's enough for at least one or two investors only to do that.
I just want to add, Liz, so 100%. So what we ended up doing was, so number one, our lead investor, the one of the US, and then we actually had one kind of, not a lead, but like a bigger investor who ended up being on our board, but he wanted to do, a lot of due diligence. And so we showed them our CRM system, both sides of the market. And instead of them just, having their own calls, we actually had we just invited them on call. We were like, here's what the next 2 weeks look like with our calls. You're happy to join any call you want. And so they just joined our calls. They sat in the background, didn't really ask any questions, but they saw our process. They saw, how they were reacting, what it was going to be. We're selling into schools, so it was, long sales cycles, and so and that's risk. And so there was a bunch there that just happened. But yeah, so we opened up our CRM, and then opened up our meetings to sit there and say, instead of you calling, why don't you just join us?
Yeah. Any final piece of advice on this one, Jacques, from your experience?
I agree with everything that's been said. I think, the main thing is you got to be honest. Like if you're a really early stage company and you're just getting into that customer, my approach with customers is you're trying to build a partnership anyway, and you use those words with them, like you're a great customer, would love to partner with you. And so then once you establish that relationship enough that you can open the kimono a little bit and say, well, we're a small company and, we don't have a lot of runway. And of course we need investment. So then you can have the conversation like Liz talked about, right? And so just be super honest, but also I think investors will understand if they're looking at you and they understand your stage in particular, they'll understand if you want to say, I don't think it's a good idea to talk to this customer. I'll let you join in on a sales call and just listen in the background if you're okay with that. It's a little bit shaky, but at the same time, that's a good way to let them hear what's going on and hear the engagement from the customer.
Just thinking of is there any request from like a VC firm that like is just like red flag, that's out of bounds, they shouldn't have asked for that, like, and then from your experience in this category, and like in customers, employees, could be in another category, just thinking about that.
I think VCs are going to ask for whatever they can, whatever they want, right? Like I would always ask for talking to previous investors, earlier investors. I would ask for customers. I would ask for, even grant people to see what they have to say, how the company's worked with them. So they're looking for all kinds of nuggets because, it's just like an employment reference. Usually if you're letting someone talk to you, they're usually letting you talk to the good ones, right? And so you're searching for those little hints of, well, they didn't quite answer us on this, or they didn't quite do this. And so you're just looking for, making sure the landscape's clear, what they're telling you is honest and evident and stuff like that. And you're not looking for, the skeletons, but they do pop up. So you want to be doing your work to do the due diligence. So I don't think there's anything that is out of line for them to ask. Typically, I haven't seen investors asking for something that's really crazy or out of line.
I agree with Jacques. It's not necessarily skeletons. What I call them is red flags. There's definitely red flags. Everybody's got them. Your job as a CEO is to reduce the amount of red flags. So, the first, one of the things that I was, love to see, because I'm a finance person, right? And I'm a big spreadsheet person, is, when I see someone's revenues and I go, oh, okay, yeah, that's what you think you're going to do, or your market penetration. I was like, okay. And so, so I don't necessarily give credence to that. It is a red flag if they don't have the ability to sit there and say, okay, well, instead of this growth rate being, you're saying it's going to be 26%. What if it's only 18%? If you don't have the ability to respond immediately within your spreadsheet to make that adjustment so that I know what actually could happen, that's a red flag, right? So there's a red flag on okay, you have really high expectations on what your revenue is going to be. I'm more looking at the cost structure. But if you have an answer to, okay, well, perfect. Yeah, so let's say it's 18. Here's how it affects me, and here's how it affects the business, and this is what it looks like. That eliminates that red flag, right? And so, what your job as a CEO, in my opinion, is to, when you're raising, you have to reduce all of the reduce the amount of red flags that you can, just overall.
Awesome. Great piece of advice. I'm going to take that as your one piece of advice, because I got to get two more people here in the final minute. Jacques, you first. What's that one piece of advice? Final question to the founders.
A little too restrictive. I think there's 3 elements. Make sure you're in a position of strength, raise money when you don't need it. And then also, I used to say, look through the eyes of the investor, but that's not realistic. So you got to train yourself to look through the eyes of an investor, so you know what they're looking for, and so you know how to pitch and dialogue with them.
Love that. Liz, take us home. What's that final piece of advice from you?
Yeah, I think when you're talking to people, really look them. This is kind of an intimidating thought, but can I work with this person for the next 5 to 10 years? Like, they're not getting off your cap table. And so this is a long-term thing, and really just from your gut, are you getting a good feel about this relationship? That's really, really important. And then lastly, just honesty and integrity is critical. I think a lot of people, build that crazy hockey stick curve with these, wild projections, this, that, and just one approach we've taken is try and be realistic but optimistic. And I think we've gotten quite far talking to VCs, because they realize they're like, oh, these are actually tangible, and these are targets that can be executed. And so just having that air of humbleness and realistic targets goes a long way as well.
Awesome. Thank you so much to our panelists. If you're willing to be contacted, please feel free to put a way to get in touch with you in the chat, whether that's LinkedIn or an email. But thank you so much. Round of applause for our amazing panelists. Thank you, Jacques. Thank you, Richard. Thank you, Liz, so much. That was some incredible insights throughout. So many great nuggets in there. Definitely going to have to go back through that and pull out some clips to use to share all of these great pieces of wisdom that you shared with us today. So thank you so very much. Hope you all have a great rest of your day. Good luck to all those in Summit 8. Top 20 pitch night is in 2 weeks today, on the 12th, in a city near you. So keep an eye out for that on our website if you want to come out and support. Yeah, we'll join us next Summit for our next prep program for those that aren't in Summit 8. Have a great rest.